But not all visual communication tools are created equal. With Y charts, each output is a powerful visual that brings your analyses to life and intuitively explains the why behind your strategy. Go beyond a simple price chart and educate clients about the levers that truly impact performance or risk, and emphasize your most important insights with flexible chart annotations. Plus, custom branding, colors, and disclosures position you to fully own those insights. Go to ycharts.com to start your free trial. My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Mark Zandi, who I know a lot of you have seen over the years doing the media runs. But Mark, introduce yourself for those who are not familiar with you. Who are you? What's your background? How did you get involved, interested in economics and markets? And what are you doing currently?
Well, my day job, I'm the chief economist of Moody's Analytics. And I became part of Moody's about 16, 17 years ago. I had a consulting firm that I started in 1990 and I sold it to Moody's. So I've been with them ever since. And so I run the research group. We've got a couple hundred economists all over the world doing all kinds of different things. And just for sake of disclosure, I'm on the board of directors of MGIC. They're the nation's largest private mortgage insurer. I'm the head of the risk committee there and on a couple of nonprofit boards as well. So that's me in a nutshell. I got my PhD in economics from Penn, University of Pennsylvania. I grew up outside of the city of Philadelphia in the suburbs. I still am there. My kids joke that I've been sheltering in place all my life. I am pretty close to Villanova if you're a college basketball fan. And I went undergrad there as well in the Wharton School of Business. So that's me in a nutshell, Michael.
Okay. A lot of things I want to ask you. I shared at the top of the space here this tweet you put out in response to Fitch's downgrade of Treasury debt. This idea that it's nonsense. Yes, Treasuries are still the pristine asset, at least in theory. Some people will vastly disagree with that and say Fitch didn't do enough. Just lay out some of your thoughts on what we've seen in the last, 12 hours when it comes to not just credit rating agencies, but also the response by the bond market.
I think it's a non-event. I don't think the Fitch downgrade has any particular impact or meaning on markets. I don't think they're imparting any new news to global investors. And, I think at the end of the day, global investors understand that the U.S. Treasury debt is money good, that, you invest in a Treasury bond to get your principal interest back in a timely way. It's the way it's been since the nation's founding, and, no reason to expect that to change. And, it's a bit odd. I mean, Fitch and other rating agencies do have, and you should know I'm not in the Moody's rating agency, so I'm outside the rating agency, just for sake of disclosure. And, AAA, you can buy Australian debt. It's AAA according to Fitch. You can buy Danish debt, AAA. You can buy Eurozone debt, AAA. You can buy Singapore debt, Swiss debt, triple. But, push comes to shove, something goes wrong in the global economy. Something even just goes wrong here. Capital comes flowing here because people, global investors know that the U.S. Treasury bond is the AAA credit on the planet. So I don't think there's, much meaning to the downgrade or any meaning whatsoever to the downgrade.
Right. And what you're referring to there's that flight to safety dynamic, right? When there's whiff of a tail event, right? You tend to see money kind of crowd into treasuries. Obviously, it wasn't the case last year. You had it momentarily during the regional bank crisis in March, and then it's unclear what happens next. I'm curious, do you think just the whole idea of having a rating on a country that has the reserve currency, is that just nonsense to begin with because we just print currency and who cares about the debt load?
No, I think debt matters. I'm not saying that. And I do think our long-term fiscal situation, if we don't make any changes to policy, the spending and tax policy is unsustainable. I mean, the arithmetic is, I think, compelling. If you just look at the Congressional Budget Office, the CBO, the nonpartisan folks that, look at the budget carefully. So I wouldn't argue that. I think we do need to, put the economy, the fiscal situation on a more sustainable path. But I think, we will, like we always have. We've had, again, since the nation's founding, lots of challenges, and we've always risen to the occasion. I don't see any reason why that has changed. So I don't think we can just wash our hands of the fiscal problems that we have and say, oh, this is no big deal with reserve currency. I think it will ultimately undermine the willingness and ability of investors to come here if we're not prudent and careful. So we need to be that. But I think we're a long way from undermining that reserve currency status or the fact that we are AAA in the mind of investors. And
when things aren't going as to script, and it doesn't even need to be a tail event. It's just things aren't going to script. We're in recession. Money comes flowing here. And even today, I mean, the US dollar which is a kind of a barometer of that, is strong. I mean, it's not as strong as it was, back maybe 6-12 months ago when the Fed started jacking up interest rates before a lot of other central banks in the developed world. It's very strong by any kind of historical standard. So, money still sort of flowing into the US.
Is there any sort of mechanical dynamic that happens when there's a downgrade like this that causes some forced selling by larger players just by mandate?
I don't think so. Not that I know of. Maybe some global investors, in their fiduciary relationship with their clients, have some terms where if the sovereign debt or any debt is downgraded to a certain level, you see some selling. But in the case of sovereign debt, U.S. sovereign debt, I'd be surprised, but I don't know for sure, Michael.
Yeah, that to me is always sort of the interesting dynamic of just market structure, right? If something crosses, right, based on a particular reading, does it create sort of a domino effect? Okay, so remains to be seen. As I recall, in 2011, it was S&P that did the downgrade, but I recall there's another rating agency, I think, that kind of said it first. Maybe I'm wrong on that. But it doesn't sound to me like you think that there's maybe a repeat of the turmoil that we saw in 2011, where when S&P did that downgrade, oddly enough, treasury yields actually fell.
Yeah.
right.
Right.
As you had the kind of flight to safety trade back then.
No, I don't see any prospect of that. I mean, as you point out, back in 2011, in the wake of that debt limit drama, after lawmakers had come to terms and increased the limit, S&P did downgrade, and the equity market, which was already pretty fragile, prior to that, because of the debt limit drama, went down further. And I think, peak to trough in that period, equity prices were probably down close to 20%. So, but I don't see any of that happening here. I mean, the fundamentals of the economy are just too good. And I don't think the Fitch rating is going to, mean that much to investors in the grand scheme of things.
Okay. So let's talk about that point about fundamentals being, too good. And just for the sake of discussion or, back and forth on this, how much of that is too good aspect related to the lagged effect of lower rates, right? Because I do think that, this is my own view, there's maybe an underestimation of the impact and delays of the fastest rate hike cycle in history on the economy. The long and variable lags have yet to, I'd argue, really hit.
I think there's some of that for sure. And I think there are some risks posed by the continued fallout from the rate environment. I mean, one thing that does make me nervous is that it's likely the Federal Reserve is going to keep the foot on the brakes here for quite some time, at least well into next year. The yield curve is going to remain inverted, throughout that period. And that does creates a very difficult operating environment for banks and for the financial system more broadly. And, there are other things going on in the system that are going to add to the pressures, that tough operating environment. Credit quality will start to weaken. I mean, credit quality has been excellent. And even if it normalizes, that'll put some additional pressure. For some more regulatory costs, loan growth is slower because of a tightening down in underwriting standards related to the banking crisis that hit back in March. So, I do think the financial system is under pressure and there's risk there. So if I had to put my finger on the thing that would undermine, the economy, undermine my optimism about the economy, that would be it. So I do agree with you. I concur with you that we haven't, fully seen the fallout from a very dramatic increase in interest rates, short-term interest rates that have occurred, over the past more than a year. But having said that, I think the economy has digested the rate hikes to date gracefully. I mean, amazingly gracefully. I mean, consumers are hanging tough. They're doing their part. They're fortunate because they've locked in the previously low interest rates through refinancing waves. By my calculation, only about a tenth of the household debt outstanding from cards to mortgages adjust with market rates, at least within 1 year. So they're relatively insulated. They got plenty of cash, particularly high income households, middle income households. And that's where the bulk of the spending occurs. And so they're not spending with abandon. They're not out, hair on fire spending, but they're spending 2% real consumer spending growth, rock solid on the nose for, the last 12, 18 months. So it feels pretty good there. And then, I can go on, but I'll just mention one other thing that, I think adds to the economy's resilience and ability to digest the higher rates, so far gracefully, is the fact that businesses just do not want to lay off workers. They're adjusting now to the higher rates and the weakening in demand. by pulling back on their hiring. You can see that in yesterday's report from the Bureau of Labor Statistics, the job opening labor turnover survey. But the layoffs are still well below kind of, historical norms. There was a bit of a pickup late last year, early this with the tech layoffs, but they've come to an end. And so layoff rates are, well below what you see historically. And I think that does just go simply to the idea that businesses know that their number one problem through thick and thin, and this was even before the pandemic, clearly in the pandemic and post-pandemic and in the foreseeable future, is finding qualified workers and retaining them. The demographics here are pretty compelling on the front. And so they're looking through whatever it is going on now. The other thing, I think the businesses is helping condition businesses' response to all this is they're hearing recession, but they're also hearing short recession, mild recession. So they're thinking, oh, okay, well, I can weather, a storm, an economic storm that lasts 6-9 months. And, I'm willing to live with that because I know, again, on the other side of whatever it is that we're going to suffer here or experience, it's going to be, labor problems. So I'm going to hold on to my labor. And if you don't have layoffs, I think that's hard to get a recession. I think layoffs are the key to recession because they're the thing that spook consumers, cause consumers to pack it in, run for the bunker, stop spending. And at the end of the day, that's what you need to get a recession. If consumers keep spending, a recession is just not going to happen.
So that lock-in effect is one that's, well documented. You can argue that's why those higher rates have really impacted the way that maybe traditional models would argue, right, as far as the economic side of things. It seems to me that if you're going to be negative or bearish, the area to point to would be credit card rates, right? It's the revolving credit that maybe breaks consumer spending. Any sort of interesting trend reversals or things that you're seeing when it comes to consumers and how they are viewing credit card interest rates? Because I go back to if the effective higher rate isn't there as much as it used to be because of the lock-in, you have to do more on the revolving side. Credit card seems to be the obvious place where the heavy lifting has to be done for the bears.
Yeah, that's right. I mean, I said the 10% of household debt liabilities, which includes cards, consumer finance, buy now, pay later, auto, student loan, mortgage, first and second. Only 10% of that, maybe a little bit more than that, is going to adjust with the shift in market rates, at least over a year. If you extend out a couple, 3 years, then you'll start to see some adjustment. So it's very modest. I mean, the bank card's only $1 trillion outstanding. And it's, back to where, if you look at the trend lines in the growth in bank card outstanding prior to the pandemic and just extend that out through time, the outstandings today, the $1 trillion is exactly where you'd expect it to be. It fell very sharply during the teeth of the pandemic. People really pulled back on credit card use, but it's bounced back. But now we're just kind of where we were, on trend with pre-pandemic trends. It's not that big a deal. It's not big enough to, really weigh too heavily on consumers in the aggregate. Now, I'm, obviously painting with a broad brush here, and there are distinctions between kind of the finances and the balance sheets of high income households, middle income households, and lower income households. And kind of think of it in thirds. That's an easy way of doing it. Thirds of the income distribution. Top third, their balance sheet is as strong, arguably, as it's ever been. Lots of wealth, no debt, locked in. Do they have any debt? They're fine. Middle income households, they're okay. It's not quite as good, but it's pretty darn good. And it's the bottom third where there's more financial stress. And that's where the credit card and consumer finance, borrowing has been most significant and more of an issue, and will weigh on and is weighing on those consumers' ability to spend. But again, and I don't mean to be, I'm looking at this from a kind of an academic perspective, not thinking about, what all this means for, low income households, which is considerable. But from that academic perspective, green eye shade, no emotion perspective, they account for a very small share of spending. Here's a good rule of thumb, and it's only a rule of thumb, but I think it's very helpful. 2/3 of the spending, consumer spending, occurs by folks that are in the top third of the income. Folks in the bottom third account for maybe 10% of spending. So, the economy can't flourish, with the situation, but it can continue to move forward and avoid an economic downturn. And the other thing I'd point out is that we are starting now at this point to see some slowing in the growth in credit card outstandings and receivables. That goes largely to a tightening up of underwriting standards by lenders. that kind of let loose back in 21, 22, where there was a lot of score inflation that led it to the very strong growth in out receivables we've seen over the past year or year and a half. But in response to an erosion in credit conditions, quality, they have tightened up. And of course, the banking crisis, reinforces that tightening. So we are starting to see a real substantive slowing in outstandings growth. And I think it probably suggests that this will become even less of an issue, 6, 12, 18 months down the road.
I know you want to talk about fair value across different asset classes. And I think it's an interesting discussion because fair is in the eye of the asset holder in general. But first of all, just from an economic perspective, explain what that term fair value even means. It's thrown around a lot. I don't know if people really understand, what it means in practice.
Yeah. And you should know I'm as an economist, I'm a macro guy. I'm looking at the world from 30,000 foot. And I really don't spend a lot of time on asset prices, except when they feel like they're and appear to be quantitatively, and I'll explain that in a minute, what that means, high relative to significantly higher than fair value or significantly lower than fair value. Because then you can see, big movements in asset prices up or down one way or the other. And that does have macroeconomic consequence. So, but barring those kinds of periods when asset prices are, within spitting distance of their kind of fair value historical norms, I'm not paying a whole lot of attention to it. It's not that big a deal. I would say that fair value it is really kind of the simplest way of thinking about it is the discounted value of the stream of earnings produced by that asset. So in the case of stocks, you take corporate earnings, you have a forecast of the growth in those earnings. You discount that back by using an interest rate. Obviously, when rates rise, that discount rate rises and the value of that future stream declines. And conversely, when rates fall, that increases the value of that stream of for future earnings. But that gives you a kind of a fair value. And so that's for stocks. For a rental property, for an apartment building, you would do this. You'd have some expectations for the rent growth for those apartments, some discount rate. You discount it back, and that gives you a sense of what the fair value of that rental property is. So that's kind of sort of how I think about it, and we use that intuition in our modeling to estimate what fair value is. And when asset prices deviate again meaningfully from that fair value, that equilibrium value, then I start paying really close attention because again, that means that asset is vulnerable to either falling significantly in price or rising significantly in price. And if that happens, that can have all kinds of macroeconomic consequences. It could be directly through the change in wealth. The stock wealth effect is, well documented in terms of its impact on those high income households I mentioned earlier, because they're such a big share of overall spending. It can have effects on the decision asset prices, particularly real estate values, can have big impacts on financial institutions because they're the ones that are providing the debt that supports those assets. And if the price falls, then, they're more likely to suffer default and delinquency, undermines their capital and, undermines their ability to extend out credit. You can also, shifts in asset values can affect people's sentiment and confidence, and that has impacts on, the macroeconomy. So there's a number of different channels through which asset prices can affect the economy. But again, I think those effects are generally small in more typical times. And it's when asset values really deviate that, I really pay attention and call it out, take account of that in my expectations for where the economy is at.
Which is further away from your perspectives from fair value, stocks, bonds, or stocks, bonds? And I'll tell you why I'm saying it that way. You have two different stock markets this year. You've got large caps, being the winner, and you've got small caps, the relative basis, being the loser. You've got treasuries, and then saying yield curve inversion and recession potentially coming, and then you've got credit spread saying that's not true. So the disconnect, I'm saying, which is more over stock bonds or stocks bonds. Is it fair to say that we're kind of in a weird environment where the co-movement of things is really unusual compared to history in terms of that valuation thought process?
Yeah, there's a lot of weird stuff going on in financial markets, and we can talk about those things and try to square them. I mean, I have a thesis as to what's going on, with respect to some of the things you mentioned in terms of credit spreads and shape of the yield curve and, what's going on with bond yields. But to ask your, original question about, which is, more out of sink? Where's valuation more of an issue? Is it stocks or bond? I'd say it's stocks. I mean, in my mind, bonds. And then when I say bonds, let's for the moment think about the 10-year treasury bond, because that's the kind of the numeraire. That feels at 4% ish, feels like it's at fair value to me. I mean, that's what our models would say. I mean, just motivated with a little bit of intuition, in the long run for an economist means, abstracting from the vagaries of the business cycle and sentiment and, momentum and all the other things that affect markets. In the long run, the 10-year treasury yield, the nominal 10-year treasury yield, which is at 4%, should be equal to the nominal potential growth rate of the economy. That's nominal GDP. And that's about 4%. 4% is nominal is 2% real GDP growth. That's the economy's real potential growth. And we can talk about what that means. And 2% inflation target. So in the long run, we are going to see 4% nominal GDP growth. We're above that now, obviously, because of the high inflation. But that's where we're going to settle in the long run. And that's where the 10-year treasury yield. The 10-year treasury yield kind of sort of is like the economy's cost of capital. The nominal GDP growth is kind of like the return on capital. And economy-wide, they should be roughly equal to each other. By the way, if you assume a simple, spread of 150 basis points with the federal funds rate target, and that's kind of been the long run, again, abstracting from the vagaries of the business cycle, spread between the 10-year and the funds rate, it should be about 1.5 percentage points, 150 bips. So that means if I'm at 4% on the 10-year and that's equilibrium, that's, fair value, then the fair value equilibrium, all economists call R star, should be about 2.5%. And that's exactly where, the Fed would say it is if you look at, their forecasts of long run federal funds rate target. So that feels fair value to me. Feels like we're, right roughly where we should be. Now, obviously, when you start looking at corporate bonds and asset-backed securities and, CLOs, I mean, there's all kinds of nuance and each market has its own dynamics and, some may be overvalued, some may be undervalued. And, right now, you mentioned the corporate bond market and maybe there's some overvaluation there. Spreads feel very thin, to me. So maybe on the margin, some overvaluation, but I digress. Equity market feels somewhat overvalued to me, not because of interest rates. Again, I said they're pretty close to fair value. Remember going back to, how do I, calculate fair value? So, the expectations of future corporate with the equity market is the stream of future earnings discounted back. So the discount rate feels about right, 4%. Maybe a little low if you're going to use a corporate bond yield. But, the corporate expectations of corporate earnings, that feels a little strong to me, compared to what I would expect given that 4% nominal GDP growth I'm anticipating, in the long run. And so, I think the market is on the high, what I would say is on the high side of fair value. And I think that would be, everything I've been saying is kind of roughly consistent with, the idea of looking at like PE multiples, PE multiples, price earnings multiples, kind of another way of looking at what I've been saying, are on the high side of their historical norms. There's, I think on the S&P, these data better than I, but on the S&P it's probably closer to 20, depending on how you measure it. In long run, it's probably should be, probably closer to 15. So that, that's not screaming to me overvalued, but it's saying, hey, the market does feel a little bit overdone here and, might be a potential risk of suffering some kind of pullback, near-term pullback and, can have some macroeconomic consequences as a result.
I wonder to think about those discounts. I wonder how much of the disconnect between large caps and small caps can be attributed to sort of the fear of, in quote, zombie companies being unable to survive rolling over their debt into the higher rates. Because, there's a lot more companies, obviously, that are smaller cap that are going to be more levered than, multinational large caps. Am I off on this idea that if you're going to look at the equity landscape, if something is, in quotes, overvalued or undervalued relative to fair value, that small caps might be the most at risk of surprise because of their own sensitivity to rates?
Yeah, that could be. If you look at corporate debt, we've been focused on household debt. If you look at corporate debt, it's, in aggregate, it doesn't look like it's a deal. It's a problem. But that's always a mistake, to look at the averages and the medians and the means, the middle of the distribution. That, by the way, is the mistake I made with regard to the banking crisis. If you look at, the averages of the conditions in the banking system, you say, oh, system is fine. But you got to look at the distribution and look at what's going on with individual banks. And if I had done that, I think I would have been much more alarmed by what was going on, with like an SVB, for example. Same kind of thing in the corporate debt market. I think you have to look at the distribution, and it feels more barbell to me, meaning you've got large companies that are really no debt. I mean, if they got debt, it's because it was free money. They backed, a year and a half ago, no reason not, take on that debt, particularly if it's long-term debt. And then you have on the other side of distribution, corporate businesses that are highly levered, really levered up. Mostly, I think, levered up by private equity firms, that have been looking to juice up their equity returns. And that's where I think there's some vulnerability. It hasn't been a big deal up till now because the maturity structure of that debt hasn't really come due, but it will. And this goes back to something I said earlier. The thing that worries me about the financial system is if rates stay where they are, if the Fed has to keep its foot on the brake for a long time and the yield curve inverted, one reason to be nervous about what that means is these companies that are highly levered are going to have to refinance in that environment. And if they do, they will find that, they're not going to find the terms are going to be very different. They can get the debt at all, much higher rates, much more onerous terms. And that's when you start to see defaults and delinquencies and defaults and probably more significant macroeconomic issues. Now, having said that, I'm not overly concerned. It's not my base case. It's not, I'm still relatively sanguine about the economic outlook, in part because I do look at, the corporate, bond spreads and corporate bond investors who are, spending to do this for a living and looking at it. They're saying no problem. Right. At least so far. Now that can change pretty quickly. We'll see. At least so far, no big deal. I mean, I look at, for example, the high yield index, the ICE index, option adjusted relative to the 10-year yield, again, the numeraire. And the spread, I think the last I looked was well below 400 basis points, maybe at 380, 370, something like that. Long run historical norm is 500 basis points. And you don't really get into a place where you really get nervous and recession is going to happen unless it's above 750 basis points. So right now, the corporate bond market is saying, Mark, relax. I am nervous about it. It makes me, queasy, particularly if the Fed has to keep its foot on the brakes for a long time here and the curve remains inverted for a long time. But for the time being, I think, we're okay. It's not existential to these companies or by extension to the broader economy.
Historically, which leads which? Is it that the yield curve leads or is it that credit spreads lead? The reason I'm asking that is there's a very tight relationship between credit spread widening and volatility and the VIX. Right. So option adjusted spreads rise, VIX spikes, because it's kind of a repricing of default risk. And a lot of people reference credit spreads as a leading indicator. Bonds lead stocks. But is it credit spreads that lead or is it the yield curve that leads?
They both lead. I think the yield curve is a long lead and the corporate credit spreads are more of a short lead, maybe 3-6 month lead. The treasury yield curve, depending on how you measure it, my favorite is the 10-year versus the funds rate, leads by 12 to 18 months, something like that. Which, by the way, would suggest, because the 10-year Fed funds inverted back, I think, October, November last year, that, if we're going to have a recession, if you take a literal interpretation of the yield curve, a recession late this year going into next, which is, if you look at most economists' forecasts who have recessions in their forecasts, that's when it's going to occur. Like Fitch, one of the reasons they downgraded was they said the next 3 years are going to be tough on the fiscal outlook. And one reason for that is we're going into recession. So they have a recession starting in the fourth quarter, which would be consistent with, that inversion of the yield curves. Now, I do think the yield curve is historically been obviously a very good predictor of recession. Primarily, I think the channel through which it works is through the financial system, the banking system. And it goes to many things we've been talking about. I mean, it goes to the net interest margins of financial institutions. That most fundamentally, financial institutions about what they call maturity transformation, meaning you borrow short at a low rate, you lend long at a higher rate, and you play that positive yield curve. If the yield curve inverts, that becomes a lot more difficult to do. You can do it. You'll be okay for a while because you can hedge, you can match. And, I think banks have done a pretty good job of doing it. SVB being, an exception. Go take a look at JP Morgan's, net interest margin in the last quarter. It was, 280, 290 basis points pretty much what it was the quarter before. So they're able to kind of match and hedge and keep it together despite the inverted curve. But if you go back historically, banks and other institutions didn't do that or were unable to do that or weren't thinking about it in those terms. The net interest margin would collapse with the yield curve. They couldn't make any money. Their profitability would erode. And then they pull back on credit. And once that happens, the economy goes into recession, particularly if that happens after a period of very rapid credit growth, because all those folks that went out and borrowed in the good times when the curve was positively sloped, those businesses and households, they need to come back and they need to refinance, and they come back and refinance in an inverted yield curve environment where banks aren't lending, then boom, that's the problem we were just talking about. And, but you got delinquencies, then you get default. Businesses have to make some hard choices, a Hobson's choice. Do I make my debt payment or do I cut my payrolls and investment? They do both and the economy goes into recession. That hasn't happened this go around. And one of the big differences between now and other periods in history when the curve was very useful as a predictor is banks have gotten pretty good at matching and hedging. They have really managed this pretty well so far. And the credit has tightened, but not to the degree that it would cause a recession. The other thing is we didn't have that very rapid credit growth, back a year or 2 or 3, 4 years ago, because, the wake of the financial crisis, people were much more prudent in their borrowing, and also because of the pandemic. So we never really got going. The credit growth really not got sent out. So we're not seeing as much debt coming due, right now. Again, if the curve stays inverted, if the Fed continues to have to keep its foot on the brakes for an extended period, and we have this conversation a year from now, and the federal funds rate target's still 5.25 to 5.5, and the yield curve is still, inverted as significantly as it is, then I think we're going to have more of a problem, and recession risk will start to rise again. But, the curve is a very good predictor. Historically, I don't think it's nearly as good in this go around, although it's, I wouldn't discount it. There's still, a sobering message in the inverted curve. We need to get inflation back down. We need to get the Fed taking its foot off the brakes, and we need to get that curve, rightly sloped again before, these bad things start to happen.
To reset the room for their meeting minutes here, but please make sure you follow Mark Zandi on X or Twitter. I guess I have to start calling it X. And if any of you want to come up and ask questions, click that bottom left micro request button. And as always, this will be a podcast under Lead Lag Live. You had said the phrase, if they can get the debt at all. And I feel like that's a good transition to housing and in particular commercial real estate. Going back to that fair value point. I've had a few people on these spaces before argue that office real estate in particular probably is done. It's kind of factored in all the bad news it possibly could. And if you're going to actually take a contrarian bet, you'd actually probably want to bet on the office side of things. Where are we in the cycle for commercial real estate and these concerns that that's sort of a real headwind going forward?
Well, I think from a macroeconomic perspective, what it means for the economy, there's still more fallout to come. I mean, you're right. I think investors have done a pretty good job. Real estate investors have done a pretty good job of, discounting the future for particularly office, to a lesser degree retail. I think there's good reasons to be more sanguine about the industrial warehouse market. Maybe it's mostly the multifamily market with some exceptions. But it's really about the office market and to a secondary degree, the retail market, particularly in those downtown areas where people aren't going back to offices. So, but from a macroeconomic perspective, there's still, more to come. We're going to, see some pretty substantive declines in construction. Interestingly enough, so far at least, office construction hasn't rolled over. It's still, quite strong, but that'll happen at some point here, and we'll see some impact from that. I'm sure we're going to see more defaults and delinquency. And, I wouldn't be at all shocked if we do see some small banks fail, that they, ultimately choke on their CRE lending. I mean, here's an interesting statistic. If you add up all the CRE exposure, and I know this because I was doing this yesterday. If you add up all the CRE exposure, and that would include loans and commercial mortgage-backed securities, CMBS, that large banks have, and large banks I'm using the Federal Reserve data. The large banks defines top 25 banks. So I think that's every bank with more than 150 billion in assets, let's say. Their share of assets that are in CRE is 7%, maybe 8%. They went through CCAR. That's the stress test scenario that the Fed requires them to take every year. in that scenario, CRE prices in aggregate fall 40% peak to trough. So, that's a pretty draconian, scary, a very highly unlikely scenario, but that they capitalize that. So I don't see any issues there. But for the smaller guys, if you look at their CRE exposure, as measured by CRE plus CMBS divided by their assets, it's close to a third of their assets. And small me, again, banks below 150 billion in assets, and that's most of the banks. So if you told me that, we're going to see some small bank failures because of CRE, because of office exposure, retail exposure in particular, maybe multifamily in the case here or there, I wouldn't argue with you. I'd say that sounds about right. Now, most times, and I think the most reasonable scenario is no big deal. These aren't big banks. They're not systemically important. They're not going to be a problem in any sense. But, we live in a kind of a weird time. You saw what happened back in March when, some small banks, even SVB was pretty small. 200 billion, it wasn't considered SIFI. They go belly up, and that created a deposit run. And of course, put us to the brink. It required a pretty aggressive response by the Fed and other regulators in the Treasury. So, it does feel like depositors are on edge. They can move their money fast because of online banking. Social media plays a role. People are getting used to thinking about money markets, and that's, a very serious competitor to banks on deposits. So, we see a few small bank failures, and that could reignite that bank run, and that would be a problem. Unclear how the Federal Reserve and others would respond to that. And that's, fodder for, a darker scenario. So I think CRE, the most likely scenario is it's digestible. It's not going to be any fun. It's going to be weight on growth, but it's not going to do us in. But, as you can see, I can pretty quickly construct a darker scenario, but it runs through the financial system, the small banks.
Talk about housing for a minute here. So I was pretty loud the last year and a half saying that I think housing's in major trouble. I use more colorful language. And that based on the behavior of lumber, because I have research which nobody can dispute, which shows that historically lumber is a leading indicator of risk on, risk off sentiment because of the link to housing. And I get it. There were disruptions because of COVID, which maybe made the signal not as effective as it could have been, or it could have just been randomness in terms of it not being consistent with the message of home builders. Unclear. But have you been surprised by this, in quotes, housing reacceleration, and how much of this reacceleration is a knock-on effect of the wealth effect of rising stocks, which I think is an interesting theory to kind of think through?
Yeah, I've been surprised. If you go back a year ago when prices were peaking, we do explicit house price forecasts, and we had house prices falling peak to trough almost 10%. And, it looked like it was moving in that direction late last year. Mortgage rates, 30-year fixed, got up close to 7%. And, by our repeat sales index, we calculate our own repeat sales indices for markets. Nationwide, that was down 2-3% from the peak. It looked like we were on track. And then, we saw some easing in rates. The 30-year fixed got down to closer to 6%. And that restarted demand. People, came back, and the price declines have abated since then. So, since the peak, June, July of last year, prices nationwide are basically flat, zero. So I've been surprised by the resilience. Now, I'm not surprised by, kind of why it's happening. I just didn't expect it to happen to the degree that it has. And that's what you mentioned, the lock-in effect. The average coupon on an outstanding residential single-family mortgage is about 3.5%-ish, something like that. So, people are saying, hey, even if I hate my home, I love my mortgage is the saying, I'm not going to sell my home with the 3.5% mortgage, go out and buy another one and get a mortgage at 7%, the doubling in the mortgage rate. And, that's just, I'm just not going to do that if I don't have to. And I think that's what's really played the most significant role in keeping the market, up. You make, the equity market may be playing a role a bit, maybe on the margin, but the price strength is across the board. It's all parts of the housing market, the low end of the market in particular. And that's, I think, less likely to be impacted by, equity effects of equity prices, the wealth effects on housing demand. Now, having said all that, I still expect some price declines here. Again, going back to fair value, I think house prices nationwide are meaningfully overvalued, probably, 10 to 15% at this point. And I think what happens is it's a kind of a slow grind down that those people who've been locked in, eventually they're going to have to sell, right? Life happens. People die, people get divorced, people have children. All those millennials that, bought, they're going to have families and they're going to want to move out to the suburbs, to raise those families. So, and job change. I mean, people are going to want to move. And as that happens, people, and they can put off the move for a while, but after a certain point in time, they can't. And I think, we're getting to that point and we're going to see life drive more sales, more inventory, more sales, and we'll see prices move lower. Because at the end of the day, the market is overvalued. Another way of saying that, it is unaffordable. People can't afford homes at these mortgage rates and at these house prices with the incomes that they have. And I do think going forward, we're going to see, I think mortgage rates will come down a little bit from here. So hopefully when the yield curve, gets more rightly shaped. And as you pointed out, that allows the kind of the spread to narrow again, the mortgage spread to narrow again, going back to, issues around prepayment. I do think mortgage rates will come in. I do think incomes will continue to rise. As I said, I don't think we're going to suffer a recession, but I do think we also still need to see some house price decline. So right now in our forecast, peak to trough, we have house prices declining. I think it's 5, 6, 7% peak to trough, not 10. So we've scaled that back, but, still see some price declines, which means some parts of the country that'll be, double digit. We'll see some double digit price declines, which, poses a bit of a threat. But final thing I'll say there, again, I'm relatively saying when it comes to what it means for the macro economy, because there's a lot of equity that was built up when prices soared. I mean, okay, suppose prices fall 10%, from the peak last summer to the trough, they'll still be up 30% from where they were before the pandemic started. That's nationwide. And, that's a lot of equity, and that, that provides a lot of cushion for, delinquency and default, and, makes it less likely that even with those kind of house price declines, we see a significant macroeconomic.
Yeah, I think, as I hear you, I think there's two dynamics to this, right? One is, okay, so even if mortgage rates come back down, it goes back to, is there availability for that to begin with, right? In terms of just credit flow, which I think is an interesting thing to think through. But I do also think there's maybe almost a psychological element to this. You hear these stories about mortgage brokers basically saying, listen, it's okay to lock in the high rate because rates are going to go lower, right? They're using the narrative that they can always refinance. Yeah, people are used to the idea that, rates will probably come back down because that's what we're conditioned to think for the last decade plus. I suspect it almost has to be sort of a collective realization that that's not going to come back again, that maybe suddenly stops net demand, or at least lessens it quite a bit.
And that'll happen over time. I mean, right now, that a broker can say that and people say, okay, that makes sense to me. But what about 6 months from now or a year from now? If we're still looking at a 6.5%, 7% 30-year fixed, will people start to change their expectations? And that will be the basis for them. One more reason for them to start, moving, particularly given if they had a divorce or a job change or, a new kid or whatever it is.
Let's go to some of the audience. My friend who's also a great follow here. Go ahead.
I think long-term rates, and again, when I say that, I'm using the 10-year treasury as kind of the benchmark. I think they're roughly where they need to be long run. As I mentioned earlier, I think 4%-ish is roughly the nominal potential growth rate of the economy, nominal GDP growth. And that's where they should be. So they'll go up, they'll go down, given the business cycle and capital flows and momentum play. So it's a market. So, it's not going to stay at 4, but I think in the long run, cutting through all those ups and downs, it will be about 4%. So I think we're roughly, where we need to be on the 10-year. Obviously, short-term rates are too high, in the long run. I mean, the funds rate's at 5.25, 5.5. That's well above, I think, most people's estimate of fair value, equilibrium, and that the R star is probably around 2.5%-ish. So the funds rate is currently a little more than double where I expect it to be in the long run. So I do expect the Fed, once inflation is within spitting distance of its target, which I expect by this time next year, they'll be cutting interest rates slowly, at first, but steadily. And then by mid-decade, they'll have the funds rate back to 2.5, the 10-year at 4. That's equilibrium. I'm sure we'll never get there, or we'll only be there for a brief shining moment because, again, these are markets and things happen. But that's kind of sort of where I think we're headed in the long run. So the long-term rates are kind of sort of where they need to be, I think. Long run, short-term rates, not so much, obviously. And they'll right themselves, but it'll take a little bit of time for that to happen. Well, 10-year yield at 4, inflation at 2. The real yield is 2. And I think that's where we're headed. And I think that's what the markets are generally saying, 2. That's where we should be on the long end. Short end, 2.5 minus 2 is 50 basis points. That kind of feels like, roughly where it's been long run. So, 50 basis point real yield on the short end, 200 basis point real yield on the long end on the 10-year. If you look at inflation expectations, they're 2% to maybe on the CPI, they're probably closer. Most inflation expectations are based on CPI. They're probably 2.5%. They're 50 basis points above core PCE. So I don't know. I think we're kind of there in terms of expectations already. The market is discounting a 2% real yield. Thank you for the question. It could be that one reason why corporate spreads are as narrow as they are is that issuance has been, somewhat depressed. But I'd say only somewhat. Obviously I work for Moody's and I look at the bond issuance data pretty carefully and, it's down, but, not inordinately so. So I'm not sure. Maybe on the margin, that's the case. I think spreads are narrow because investors are generally sanguine about credit risk. There's some risk out there and that may manifest itself again if the rate structure stays where it is for any length of time, more than a year or so. Then as, more corporates refinance, we'll see more credit problems. But barring that, if things kind of stick roughly to script and the Fed starts easing policy by this time next year and the curve starts righting itself, and there's no recession, which I don't expect, then I think spreads are, they're narrow. The corporate bond market feels to me, again, a little overvalued relative to my measure of fair value, but, not screamingly so.
That's a good place to wrap this sort of space up. Mark, where can people find some of your work?
Well, I'm at Mark Zandi. I'm on Twitter. It's, X. I do have a podcast. Thanks for mentioning that, Inside Economics. And we do that every week and it's up there for folks. You got to be a little nerdy, but given this conversation, I think everyone on the call is probably a little nerdy. So I think you might enjoy that. And we also have a website called Economic View. It's a paid site, but there's a lot of stuff that goes up that's for free. A lot of stuff I write's for free up on the site. So you feel free to, take a look at that. It's called Economic View. And then of course, if you really want to get to know our products and services, let me know. I'll have someone talk to you about that.
Thank you, Bree, for joining. Thank you, Mark. Again, this will be a podcast. Thank you, Mark. Appreciate it.
Yeah. Take care, Michael. Thanks for having me on. Take care, everyone.